Greetings and good weekend, everybody. This is Jeff Scott. Whoops, I should turn off Skype when I do this. It's September 21st, 2014. Actually, it's still the 20th. It's almost the 21st. And this is my weekend review. The title this week is really a follow-up to last week when I asked if those were bear shots across the bow. I think that the bear is poised to attack, and I'm going to make my case and discuss how I'm going to handle the upcoming market. I won't say that I'm in the fully convinced part of the bear camp, but I'm getting there. Fortunately, I'm not the guy in the picture who fell into a bear exhibit at a zoo, was mauled a little bit, but ultimately recovered. Disclaimer, this is for educational purposes only. Any recommendations are in the spirit of education and should not be considered investment advice. I'm a doctor, not a broker, and most physicians lose money with their investments, so I think that's something you should keep in mind. I am truly independent. I have some great relationships with some of the proprietors of the programs that I use, but like you, I have paid for everything. No one pays me to promote them, and I talk about the things that I use and I like. I'm not going to spend a whole lot on this slide today. If you haven't seen it before, this is sort of my wall of key influences and influencers. Woodward and Brown are really the heart and soul of HGSI, the philosophy of the trading. Much of this comes from the work that Ian developed after becoming a student and fan of William O'Neill of Investors Business Daily and How to Make Money in Stocks. Gil Morales and Chris Katcher previously were money managers working for O'Neill, who have brought to the market some great techniques like Bible gap ups and pocket pivots. Alexander Carey Lavorne, multiple books, great seminars. Recently took this picture at a live meeting in New York. A friend now in Palm Beach and a mentor and someone who I really enjoy learning from, John Person. Mastering the Stock Market is his latest book. John is got a great history. He's been trading since I was in med school. Sorry, John, that makes you old too. But he was on the Chicago Board of Trade. He's very experienced in futures, options, and trading stocks. And a lot of the things that he does, and he uses different names, are similar to what we do from a top-down approach, understanding the market, sector rotation based upon seasonality, and I'll discuss some of his techniques as I go through my various programs, and I'll also mention an upcoming meeting with John that I'll be participating. A number of other people here are sort of applying the stuff. Jesse Stein and Mark Minervini are great books from people who apply some of the things that I do and I've learned. Van Tharp, Money Management. And then my buddy George Lee, someone who I learn a lot from and enjoy discussing the market on a regular basis. I entitle this Be Your Own Guru, and really that's what you have to do. I've done my work. I am comfortable trading my account. You need to do your homework and your studying and become your own guru. I kind of put this here for a grin. I've always been sort of balanced fundamentals and technicals, but reality is my fundamentals are mostly earnings per share growth and revenue, and looking for stocks that have multiples that are lower than their growth rates, and using that in sort of my own pricing model. I decided to spend the weekend in Peachtree City, which is southwest of Atlanta, and getting to know a guy named Phil Town. He's a well-known author, motivational speaker, totally fundamental driven. It's probably not my cup of tea. For example, I think we spent 5 hours yesterday reviewing a stock, reviewing its balance sheet and its fundamentals, and making a decision whether it's something to buy based upon the price and what we thought it should have been through various models. We didn't even look at the chart. Totally opposite of perhaps how I approach with HGSI, but I think it is important to recognize that there are multiple different people out there. There are day traders, swing traders, and position traders. There are those that trade stocks, those that trade futures, those that trade instruments, or the main instrument versus derivatives such as the options. And there are people that make their decisions not by technical analysis but by fundamentals and trying to find stocks on sale. So It's actually been a great weekend. I have learned a lot, and even though I am more leaning towards the technical side, I always have, I think there are things that I learned here that I will be incorporating in my trading going forward. The other thing to point out about Phil is his books are inexpensive on Kindle or at your Barnes & Noble or wherever you would buy your books today. And the other thing is that he has these meetings where they're free. If you buy his book, you can get a quote scholarship. I'm actually here on scholarship. First time I've ever gotten a scholarship. I always never qualify, not the academic issue, but the other way around. But it's actually been interesting. For those who don't know me well, I have probably bought every expensive trading program on the market, and they sit on my desktop. So people ooh and ah when they sit next to me on an airplane, but I hardly ever use them. What I use is TradeStation Thinkorswim for trading. I'm a big fan of Genesis Trade Navigator, and that's taken on an increasingly big role in my trading, especially in my analysis real-time in the market, both of stock and the futures. And then for analysis, pretty much aftermarket closes HGSI and EdgeRater, and EdgeRater utilizes HGSI's data and structure and has some awesome market timing modules that we're going to look at tonight, because I think today is all about the market and much less about individual stocks. I'm a big fan of seasonality. Pretty much I have Best Choice and Magenta. They are both great programs, but there's some sort of simple things that I can do from a seasonality perspective with EdgeRater. And then I use MarketSmith sort of to back up my source of fundamentals and to look at how they look at some of the structure of some of the charts. Speaking of chart structure, this is our good old friend that I put up every week and talk about where I think the market is. And we have clearly been living in uncertainty. One thing that John Person says all the time, and I hear it from other folks, is that a top is a process, a bottom is an event, and that it's a lot easier to call out and identify a bottom when it's happening. I think that we've been in a topping pattern now for several weeks, especially on the small stocks, and we'll look at the Russell and the NASDAQ. And I keep thinking that we're going to break out of this red circle and go into stage 4 fear and see the prices get marked down considerably. And I do believe it. That's how I'm playing it. That means I don't always have a great week if the market goes up because I'm hedged, which I sleep better. But this week, for example, I didn't do as well as I would have liked because I did take a hedge, and I'm probably a couple weeks early on that. But what we've seen and what I have to be prepared for is every time I think we're going to drop through, we bounce up again. And so there are, if you look at some of the gurus that I follow, some of them have market timing systems that they publish, and many of them went long in the middle of the week. They were short last week, and I suspect that come Monday they might have to reevaluate. So this is a tough market, and I think it's indicative of what a top feels like. Now, some of the things that I do using HGSI is I create a number, and if you've been here before, you know this, and I apologize, but I think these are important clues as to what to expect. I create a number of artificial indexes that represent some of the types of stocks that we trade, and I look for evidence of them selling off because I know that leaders often fall first, and that if the leaders are rolling over, that might give me a heads up that the market is changing. This is Ian's Canaries. They're listed here. They were the big players. They had a big run up last year. They peaked in March. They took out the new highs in August, set a new high here beginning of September, and have been pulling back since. Last week they were on the 17-day, and it did not hold. They did knife through the 50 and closed midway between the 17 and 50. I think they're sort of at the OK corral, and that they can go either way. There's a doji sitting there, and I'm going to see what happens. Now, these stocks have been performing well, but they haven't all been performing in unison, and this may be the time that we see things like Facebook and Google pick it up and perhaps lead and take them higher, but we'll have to see. This is clearly, to me, we got great support at the 50, but a break through the 50 and we could see quite a big pullback in these. What about the LOURs? This is a group of stocks that were picked in March to sort of give us a heads up of when the market was going to roll over. You probably can't read it, but it doesn't really matter what the stocks are. But what I see is that the market really traded sideways from the beginning of April, a bit of a pullback in August, and here we are sitting on Friday. Huge volume, but I think the volume can be blamed purely on quadruple witching hour. Much of it came in the last hour of trading, maybe even the last 30 minutes. But you've got a pretty ugly looking red candle that took out the 17 and the 8-day exponential moving average. Now, I would like to see this quickly get back above the 17, but if I'm bearish, I'm expecting a visit down to the 50, and we'll see if the 50 holds. In Florida in June, we did another list, and this is the most recent, freshest list. And as you look at some of those stocks, you know that many of them, such as U.S. Silica, is in a big pullback right near all the energy stocks, and there's quite a few here. The GPREs got hammered. LCI got hammered, but seems to be holding on now. So there's been some pretty fierce sector rotation. But the interesting thing is we are right below the high. The problem is it looks like we're stalling. We did test the 50 and it held, and that might be bullish. But we close sort of at the 8-day exponential, and again, I'll be watching this. So my summary and what these last three charts mean to me is that clearly we're stalling. Now, whether we get another leg up or we get a leg down, I need more information. But I see a market that, in best case, is stalling. So market themes remain. I leave some of these, I add some. The market resilience, despite lots of bad news, think ISIS, Ukraine, etc. There's going to be easing in the EU, which is bullish. Falling in oil and gasoline taxes. Gasoline might be considered a tax break to the masses. Despite all the Fed concerns, interest rates remain low and will remain low for quite some time. If you look at weekly on the indexes, they look great. And we were waiting for the Fed meeting, and the statement was perceived as less hawkish than anticipated, and the market traded up substantially Wednesday and Thursday. Friday, different story. The bear case, rising dollar. That causes oil to go down, gold and silver down, and long term this will have a negative impact on equities. Now, I showed a chart last week or the week before that showed the significant market declines when QE1 and QE2 were withdrawn from the market. Now, QE3, or as some people call QE infinity, is set to end in October. So that might be pressure on the market. A lot of people are expecting rates to rise, and when that happens, that will be a problem for the market. But as I said, the Fed was less hawkish than expected. Now, I was worried, not worried, I felt some entropy in my holdings on Friday on my longs, but I actually did okay because I've got a substantial, I've got a big TZA position, which is just a short-term trade because of the weakness in the Russell 2000 that helped me. But there was a weak close on Friday, but there was complications. You had Alibaba coming public and taking a lot of money out of other like names. You also had quadruple witching. So this week I'm going to trade the market I have, not the one I think we should have, so I'm going to wait and see what the market does. My signals suggest to me a more bearish stance, and so I did end Friday with my bearish ETFs in place, some puts, both protective and for speculation, and I put on another OEX put spread. I can tell you the last time I put on an OEX put spread, 2 times ago, it was very profitable. Last time it was not. My bottoms-up review from this weekend, Friday's close was weak, as I mentioned. Many recent leaders are falling back. Go try and find a strong, besides maybe EMES, strong oil and gas sector stock or drilling stock. There are not a lot of attractive long setups. What is working? Defensive stuff. Railroads and railroad makers like Trinity and Greenbrier. Utilities and other interest pairs like REITs, MLPs, tobacco, Coke and Pepsi. I mean, things that as a growth stock investor, I almost never touch. But I'll have to say some of those actually look pretty good from a fundamental story. versus some of the high growth stocks that I'm usually buying. Just to remind you that there is a John Person seminar coming October 12th and 13th in Singer Island, Florida at the Marriott. I will be speaking there. I'll follow up on the next comment on the next slide. I don't know if there's any seats left, but George is doing an advanced seminar in Orange County on October 3rd through 5th. A PV meeting, Palos Verdes, California, October 20th to 22nd. Unfortunately, the first one in ages that I'll be missing. And I'm finishing the touches on doing a meeting in February down here in South Florida. So this is where I stand on the prequel meeting. I'm going to limit it to 10 attendees. Registered attendees for John Person's meeting on the 12th and 13th will be given preference. Followed by that will be local members of my meetup group who will be offered remaining spots. The agenda and topic is to become your own guru. I will do 2 pre-meeting web sessions to review the practical use of HGSI. And in the meeting, it'll be language, tools, and philosophy of HGSI, incorporating the best of other gurus, finding your star trade, stops and money management, and putting it all together in my process. All attendees will get a screencast of all presentations, as well as my Adobe files from the presentations. $300 including breakfast and lunch, $200 if you are also attending the John Person meeting. If you do not fit the 2 bullet points and you're interested in coming for the one day, email me, and then if there are spots available, I will consider. I want to be perfectly clear, this is not a replacement for a Palos Verdes meeting. This will be one day, and I hope to condense much of the material that I did in 3 days in June and have you leave there with a great understanding of how to get value out of HGSI Edge Rater and to help you on your way to become your own guru. Email me for further questions. I think it's important that we keep an eye on seasonality. So here I ran a bunch of major ETFs, and I ran them with historical performance now. And what it does is it goes forward. You can look at 2 weeks from now, a month, 2 months. So I basically ranked them by return over the next month. The next 2 are how many up years and down years. So a couple of things come out of here. The first thing is there's no champion. There's nothing that has been up 10 out of 12 years over the next month, or even down 10 over the last 12 years. So that tells me over the next month, these things probably have as much chance of going up as going down. That said, if you look at the average return over what could be as many as 20 years on the spiders, which was flat, you see that only 3 things with varying amounts of years are actually positive over the next month. REITs, and boy, were there REITs in my review this weekend, up 14% over the last month, over the next month, based upon 13 years worth of data. But again, notice it's not a lot of conviction there. It's more 50-50. European and China stocks up, and the U.S. stocks, average performance, home builders -7, metals -5, bakes -5. So for the most part, the stocks that we trade, we're going into a seasonal tough time. But that said, they kind of look like half the years they're up, half the years they're down. But you've had some pretty bad down years to bring that average where it's at. The week ahead, as you look at it, we have some GDP information, some housing and mortgage index. We have our usual crude inventories, and we've got continuing claims. We're getting near the end of the month. You also got the mission sentiment, but it's a final of one that's been reported. Also, the third estimate of the GDP. So all of those, the GDP and the Michigan sentiment are follow-ups of previously reported things. Not a big week for earnings, so you'll be looking for other news to drive the market. And like I said, I'm on bear watch. Doesn't mean I've gone short across the board. It means I'm heightened concern. Big gap open on Monday, I'll lose a lot of money, but I'm betting that that's not what's going to happen. And if it does, then I'll manage it and I'll reduce the impact on my portfolio. All right, so now let's go take a look at some of the clues the market's giving us. Yeah, I actually did buy a new car, another car. This is a Porsche Turbo GT S. 0 to 60 in 2.7 seconds, like a 56-year-old man needs that, but I like toys. Somebody had asked me when they saw the backdrop. Let's quickly look at my elder indicators, because I think today's big theme I want to look at is the market. And I think I'll show you some neat stuff with EdgeRater as well as far as my timing. So here's the bull case. Bull case is we hit a new high, closing high on the S&P on Friday, that the weekly bars are clearly painted green, or excuse me, daily bar is green. And for those that have been with me, know that the way that I've learned this from Alexander Elder, great books, great guy, great teacher, is I understand that to be green, you have to be above the exponential moving average, price above moving average, and your tick on the MACD histogram must be higher or less negative than the prior. When both those occur, you get green. When your price is below the moving average and your ticks on the MACD histogram are getting lower, if both of those occur, you're red. And if you don't have agreement in the price above average and the MACD histogram, you are blue. These are not buy and sell signals, so if I ever say that, ignore it. What they are should be filters, that when the S&P is green on the elder indicator, you should not be running out and shorting the S&P. When it is red, it tells you the market's under pressure, and you probably don't want to be going out and taking a long position. When it's blue, it doesn't filter you. You could be doing long, short, or staying the same. So the S&P 500 is my bullish start and says, Jeffrey, maybe you're too bullish. Don't short the high. And again, I'm balanced in my holdings right now. Wait for the market to turn. You're green on the daily and on the weekly. Now this little red dot here, and there's probably one up here, shows that there's some MACD divergence. And the MACD divergence is basically saying that we're getting higher highs on the weekly, but we're not getting higher highs on the MACD histogram, which suggests weakening of the up movement. So that's the S&P 500. Now a little bit more quickly, the Dow, big stocks doing great, except you had a big shooting star on Friday. There's your MACD divergence concern, that red dot on both the daily and the weekly. But if you want to be bullish, there's your proof. You're green across the board on the Dow, so big stocks looking pretty good. Semiconductors, well, semiconductors have also been doing very well. I think Intel's been a big part of it. I've seen a lot of movement underneath some of the big guys, maybe the Apple iPhone, and figuring out who's inside, like I think Skyworks may have been inside, and AVGO. NXPI has the MFC. Qualcomm, I think those might be driven a little bit by the excitement about the iPhone. And we went blue on Friday, so you really do have flexibility here. You can see the MACD divergence showing up with the red dots. Now let's look at the NASDAQ 100, the biggest stocks in the NASDAQ. Also, got a spinning top, but you're still green. You're blue here with lots of red dots, so clearly the MACD divergences might get you concerned, but let's be honest, we've had MACD divergences since probably June, and the markets continue to trudge higher, at least the NASDAQ 100. So why am I concerned? Well, let's look at the S&P 100. Also looks good. Bit of a shooting star. Could be setting up an evening star with a gap down on Monday. Here's your MACD divergence red dots. But at least by color of the bars, you could be feeling bullish. Then you look at the Russell. And a little bit different picture. And will the Russell pull the rest of the market down? Is the Russell a leading indicator here? Usually it's not the Russell that's going to tell you direction. Or is this just an aberration? But you can see the color on the Russell. We'll look at it some more. I think the Russell's giving us a better representation of the underlying weakness in this market. But I showed you the others for fair balance because you could certainly make a case with the color of these bars that I am too bearish in my feelings. And by the way, cash is a position. If you are confused, I'm clearly confused, but I'm trying to do the best I can. I'm managing my money, but if you can't figure it out, cash is not a bad place to hide. Now let's see if I can get any more information out of my tools in EdgeRater and some of the other HGSI stuff. As I said, wasn't a great week for me. Interesting thing is you got as much black as you do red. So overall, the market wasn't that bad. The S&P 500 was up 1.25%, clearly a leader of the week. Our GIF All-Stars were actually up 2.18%. The IBD 50 was up 0.71. The HGS 100 was up 0.46. So the Market Smith 250 growth was up 0.26. So there's a lot of good stuff here, and perhaps I should be less bearish. And that's just certainly something that I have to be careful of as we go into this week. But I do think the week ended differently than it felt on Wednesday and Thursday, and I don't know which way it's going to go this week. One of the things that I have used and learned from Ian over the last several years is the Hindenburg Omen. Now, the Hindenburg Omen historically is calculated on the all NYSE index. And for those that are new to me, especially my new friends that I've met here at the Phil Town seminar, a Hindenburg Omen is a signal that occurs infrequently. It may occur spuriously from time to time, and we know that probably only 25% of signals are meaningful. If it's a meaningful signal, it will probably come with a fusillade or several signals occurring over a short period of time. If I see one or two and I don't see any for another month, I drop off and I don't worry about the Hindenburg until I start to get more evidence of them. Now, the mathematics behind the Hindenburg are new highs, new lows, more than 2.2%. So both, you have to have lots of new highs and new lows. The moving average of what you're studying needs to be rising. Now, I'm not sure that the moving average is clear, and it might need to be a shorter one than we typically look at. The McClellan for that index must be less than 0, and the new highs cannot be more than twice the new lows. If you meet all these criteria, you get a Hindenburg Omen. If I was to go back and show you 2007 and 2008, the Hindenburg Omens fired multiple times, giving us ample warning that the market was going to correct. So when I did today's Hindenburg Omen on the all NYSE, what I saw was 3 out of 4. Now this is interesting. The one place we missed on was the moving average was not rising, which is kind of interesting as we're hitting new highs on most of these indices. So I'm wondering, and I don't want to curve fit this, so I didn't change the moving average so that we fired, but I'm concerned that this is losing its validity, not because the Hindenburg doesn't make sense, but because of the all NYSE includes so many strange instruments, preferred stocks, bond instruments, interest rate related instruments, and perhaps we may not see a signal because of that. When I look at what goes into a signal, this looks like a confusing market. Lots of new highs and new lows. The market's still going up. The McClellan has dropped. And then the ratio of new highs to new lows starts to flip towards more new lows. Is that not what this market feels like right now? I think this market feels like a Hindenburg, but we didn't see one. So I played a little bit. Again, I'm not trying to do curve fitting. I looked at the all NASDAQ. And when I ran the all NASDAQ, we had a Hindenburg. Now, I have no idea if that's a valid Hindenburg. But as I said, my gut feels like we had a Hindenburg with market turning over at a top, new highs and new lows firing all over the place, and confusion about where we're going to go. Is this a valid signal? I don't know that, but it's further proof to me that this is a market that's struggling to figure out where it's going. I looked at the Russell 2000, and I looked just like the NYSE, as we didn't have the rising moving average. Now, if you look at the moving average, it is right here. And we dropped from 527 and 1396 to 527 and 0192. And that was enough to not be rising. But boy, is that close. And then lastly, just out of curious, I ran the template against the Russell 3000. And I get the same findings. And if you look how close we are to a rising MA. So can I say we've got Hindenburgs? Nope. Do I have to say that we're about to roll over because of the Hindenburgs? No. I'm concerned. Bucketology. Last week, I thought I blew it because last week we had this picture with about, actually this was on Monday, with 22% of the stocks in the S&P 1500 trading below the lower band. That has typically been the sign of a bottom with a market rebound. And then we did rebound midweek. And last week I said, I just don't believe this one. And here's where we sit today, where it's sort of spread out, more neutral, and certainly not giving me a signal that a bottom is in. Here's what a top looked like the last time. It didn't even look like much of a top, as we didn't really push to the right. This was August 29th. This is a more typical bottom on July 31st. And then this is a more typical top that we saw on July 1st. Now, the validity and back testing to support this methodology for calling market tops and bottoms is applied here. And I'm not going to spend too much time because we've reviewed this before. But this has been a very accurate determinant of market tops and bottoms during this bull run. I just think it's different this time, and I'm doing my own research to determine whether or not these are valid signals in a flat or falling market. Let's talk about the markets. One of the things that Ian has taught us is the Woody indicator. And the Woody indicator looks at percent B times bandwidth. And I'm just going to talk about the one. This is the signal column. And so we start with market indices. These are all major indices. Green to me is a buy, go long time. Red is a time to be concerned about short. And when it can't make up its mind, it feels like chop, and it's hard to make money. And you could see for the major markets, we had a nice period through the end of August and beginning of September. And now we've gone into more of a choppy period of time. Now, we had a series of kahunas to the downside that sort of ended the good market. But then we had kahunas to the upside. So this is a confused market. So I don't think it's just Jeffrey and you that might be confused as to where we're going. I think we're getting mixed signals, and I'm waiting for it to declare. So I decided to expand my analysis and look at some other things. I looked at sector rotation. And this is actually an interesting thing because you can look at the major sectors and see when they're working and when they're not working. And as you look down here, I don't see anything that's in green, but if there's weakness, what's the second column? The second column there is XLY. So XLY is a weak sector right now. Now, I'm not good enough to remember what all the sectors are, so I'll go to my little cheat sheet, and XLY is a consumer discretionary. So I guess if we have all this free money, maybe we should be doing better there. I might look at how the Direxion 2X and 3Xs are doing. So here's a number of the 3Xs and 2Xs based upon the underlying instrument. And you could see that the bullish 3Xs have been doing well for most of the year, but they're in chop right now. And while they're in chop, you can see the bearish ones, which have had a tougher year, a lot of red and yellow, you'd expect them to be equal and opposite, they are also in chop. So I think there's confusion there as well. Not going to spend much time looking at the George Lee signals, but you haven't seen me do this before, which is I actually have incorporated, I've scanned for both the bullish as well as the bearish, because I want to find stocks to consider on the short side if I'm correct that this market is topping and falling over. And then we'll look at some of the bullish stocks, which include things like utilities and Coca-Cola, in a few minutes. And we can look at Georgia's signals on both a daily or a weekly. And sometimes the weekly is a better place for me to go fishing. Some of you are fans of Morales and Catcher. So just to give you an idea of where we are in this market, this is the code blue. And you could see that there are not a lot of kahunas to the upside. And we end up the blue signals when we get down somewhere down here. Somewhere in the mid 300s we started running out, but really there's not a lot of blue signals here. And if I look at the code red, we see red all over the place. So there's clearly a lot more bearish signals from the Morales and Catcher indicators, the Bible gap ups or gap downs perhaps, and pocket pivots to the downside. I look at seasonality in EdgeRater, again trying to get an idea if there's anything that's working well. And you could see that you've got some of these have, here's 17 out of 20 years up for the next month, averaging 3%. I don't know what many of these do. I suspect that several of these might be REITs that I'm not aware of, matching them up. And I look at the seasonality ETFs, and I'm not going to go through the JP stocks today, but I've actually built spreadsheets in EdgeRater for helping me. This is not available commercially. Find stocks that are meeting John's signals. So again, just by looking at the quality of what I see in the code blue, code red, and the George Lee signals, I see a lot to be concerned about in the market. So I haven't given you perhaps enough to make you be as bearish as I'm feeling. I just think that this market is tired, and I hear from a lot of other smart people that their concern's the same. Doesn't mean the market can't go up another 10% from here, and if it does, you'll see me Monday at 9:45 or 10 o'clock quickly trying to change my posture on my holdings. All right, this has already gone a long time, so let me do my review now with HGSI. I thought today was important to look at the market and understand. So I start HGSI by going into the warehouse view, and I'm going to go into Major Markets Plus, which is one of the Woodward and Brown, and I'm going to put the top-down view on. And the top-down view is mostly performance over the last day, but it also looks at the last week and the last 3 weeks and then ranks them by raw combo what's been performing. Well, no surprise from the prior pictures, but the Dow Jones Industrials is the leader of the pack. And the small stocks are down here. The small cap 600 and the Russell, gold and silver are very weak, and the big stocks are up on top. Okay, well that's kind of fits what we thought. The dollar's also on top. We've been talking about that a lot. 5-day performance, gasoline up 2.4%, the Dow's up 1.7%, big stocks up here. Volatility dropped 9% over the last 5 days. Silver and gold are being hammered, as are the Russell and the small caps, all down more than 1%. If you look at just Friday, you can see the only thing up more than 1% were Treasury bonds, which is defensive, followed by utilities, the dollar. There's nothing except for the big stocks that even were close to break even on Friday. A lot of weakness in the Russell, down. Most of the weakness for the week occurred for all of these on Friday. If I take a look at these indexes, just opening up the charts here. Let's go to an easier chart to look at. And let's open this up a little more. As I said, we're still in a big uptrend, and when you look at a weekly chart on the S&P, what's not to love? Right? And this is, I think, the bull case. The bull case has to be, Jeff, you're too bearish, because if you look back to March of 2009, we are riding above that 17-day moving average and or 17-week, which is kind of like a 50-day or 85-day, until we break below that 17-day moving average. And for those that are new, 8-day exponential, 17, 50, and 200, this market is in a bull run, and I shouldn't be so bearish. And I'm not bearish, I'm more neutral. And I'm protecting positions with some of my more bearish positions. I'll get bearish when we break down. I don't think we've broken down yet. We're just showing signs that we may soon. So a weekly chart, the S&P looks strong. If I look at it on the daily chart, I see us nominally setting a new high, ending up the market on kind of a doji-like signal, although it's probably too thick for a doji, at least a spinning top, which could be a sign of indecision. It'd be interesting to see if the market pulls back on Monday. If I look at the Dow Jones Industrials, we already saw them. They look very strong. And I just was measuring, I was trying to figure out where corrections might be. Since I took off the fibs, that's not going to make a whole lot of sense. But you could argue the Dow looks great as well. And if you look at it on a weekly, go back a little bit to March of 2009, just like the S&P riding up at 17. A few visits to the 50, but it hasn't visited the 200 since 2011. You could argue that these are all very extended. If you look at it just for the last few days, huge volume on Friday, closing at all-time highs, closing near the high, and this is sort of the mitigator of my bearish sentiment. That is very strong looking for those 30 stocks. If I look at the NASDAQ composite, similar idea. Does it look to me like it's pausing 3 dojis in a row, or doji-like multiple spinning tops? Yeah, that looks to me like it's stalling. We could wake up tomorrow and ISIS could give up the fight and we open up 10%. You never know what's going to happen tomorrow. And again, the reason this is on the weekly. Let's go to the daily. I should have done that. Not as pretty. So the weekly says, gosh, this is still very strong. The dojis on the weekly are bothersome. And here's what we're seeing on the daily. The NASDAQ failed almost exactly. This stock high on the 3rd of September was $46.10 and 14 cents. On Friday, it failed at $46.10 and 57 cents. So you had a failure at a prior high. That's the second time it failed at that level, and it sold off the rest of the day. To me, that makes me a little bit nervous. Big volume on the day, but again, you had Alibaba coming out. You could have had shifting of funds out of other tech stocks, which could have hurt the NASDAQ, and you had quadruple witching. So we'll have to see what it does next week, but this is why I'm a little bit concerned. And then I bring in the Russell 2000, and this, whoops, that's a 1000, I'm sorry. And when I pull this thing out a little bit, see, I look at this, and let me clean up all my markings. I clearly am afraid of a top here. And let's keep cleaning out my lines. Let's look at this on a weekly basis. Now, the bull case, Jeff, why are you nervous? You pull back to the 50. You've done it multiple times and you bounce. Clearly, that's the bull case. The width between this 50 weekly and the 200 weekly is expanding. We are clearly getting extended. We haven't visited the 200 again since 2011. Oh my God, since mid-November 2012, we haven't really closed except for a day, a week, 1 or 2 weeks below the 50 weekly moving average. This is a bullish market. But as I look at these last 3 weeks, I'm seeing lower highs. I'm also seeing higher lows, so I think we can read into it what you want. I'm concerned that we're getting to a market that looks like it wants to roll over. Again, the Russell should not necessarily be leading the market. I'd rather see confirmation with the big stocks, but that's why my short positions are mostly aimed at the Russell instruments and not necessarily at the blue chips. Volatility, it just struggles to get up to even 20. It used to be, at one point in my life, 20 was not a big volatility. Here was volatility back in the flash crash, not the flash crash, but in the debacle of the banks and the mortgages, where it got close to 100. Here is the 200 weekly moving average. You can see it's falling and it's been resistance. So if this market was truly rolling over, and this is sort of the bullish case, we would expect to see a rising VIX. It is tough to make money on the long side on a rising VIX, but with the VIX struggling to get above the 200, that could support rising prices. One of my concerns for the last several weeks has been the dollar, and the dollar has really broken out substantially, got above the 200 after failing here. It broke out in the middle of July, and it's got a ways to go, but this is probably resistance at $23, going back to the 13 and 12 high range. The dollar gets stronger as we start to tighten in the setting of quantitative easing in other parts of the world. If the dollar's strong, then you know what gold and silver look like. So very quickly, you see gold. Here's support about 115, and we're not far from support. This is major support. End of 13, early 14, July of 13. One might expect gold to bounce at this point if it's going to hold. Failing here is not so good for the glitter. Silver, even worse than gold. Big move down on Friday on giant volume, but again, it was quadruple witching. The next thing I look at as a top-down investor is to look at what the major, well, some of the internals. So very quickly, I'm going to go down to major broad market indices. I'm going to pull up the S&P 15 and show you some of the things that I find concerning. Now, the reason why I'm looking at this index is that this is rolled up from the stocks, and so unlike the S&P 500, I actually have volume. And I'm going to switch it to what we call the eye charts, which are market internals, and I'll show you some of the things that concern me. Start up here, and the bongos, which are a long-term indicator of direction, the weeklies are in a sell or in a red, and the dailies are in a red. The force indexes also this week turned red as well. That's a very bearish looking pattern. If I look at new high, the accumulation distribution, the red, which are the E's, are now higher than the A's, which are the greens. And you can see when you look at A through E, the greens are heading down and the red colors are heading up. That is not a good sign for the market. If I look at number of issues trading above or below specific moving averages, you could see that we are still holding above the moving average for those stocks that are trading above the 50-day, but we've pulled back on the 20 and 30, and we have a long ways to go to get to that point where my cursor is, where the market seems to reverse. So if you know, I wouldn't expect a bounce from this level based upon prior pain in the market. And was there anything else I want to show you here? That's about it. So let's go down now. Let's take a look at sector rotation and what industry groups are working. And I'm going to stick with one more week, my 2-day force. I'll probably move that to a 5-day force next week. Of our 170 groups, there are only 17 groups with positive force to the upside. Now, if you look at those groups, utilities, rank them by raw combo, I'm sorry. Internet media, that's where I'm playing a little bit. I'll look at those, but midstream, beverages, refiners, tobacco, large pharma, rail freight, REITs, they all pay dividends, and many of them would be considered defensive stocks. So I basically look at the top groups to see if there's anything interesting. I did something bad. I've got to highlight. Come on. Highlight, right click, change to index group. And Twitter is on my buy list. I actually own some Twitter. And let's put it into one of my charts. And this, to me, is the best looking group out there. So here's Twitter. As we know, it's a recent IPO back in 2013. So I don't have data before that. And it looks like it wants to break out. Price is right below the PSAR dot. It had a mobile breakout on Friday. Everything's green on the technicals. And that's one that's on my buy list if the market is holding up and it breaks above that dot. That's Twitter. Another one of my long holdings is Facebook. And Facebook took out its PSAR dot on Friday with a mobile breakout from a squeeze. Everything is green up here. It had a pocket pivot. On balance volume is moving up. I like Facebook as well. Google is also one that I actually looked at from a fundamental perspective and looked quite strong. And these are really the three stocks that I'm most interested in as I look at longs for the week. And they're the top ones that come up on my sector review. And you could see a mobile breakout on Friday. Everything is green, Kahuna and Pocket Pivot. Other stocks up here are less interesting to me. If I look at what else is out on the leading industries, and now let me be very clear, I'm not going long on anything unless I see evidence that the market is holding and moving back up. This will guide me into what I might be looking for. The midstream, these are companies that handle everything between the drill and once oil comes up to when it gets into your house or your car. And the nice thing about the MLPs is many of them pay a dividend. So the charts are all kind of similar looking because they all had suffered the last couple of weeks because of concern about rising rates. So here is TransCanada Pipelines. You can see it's got earnings. It has a 3.2% dividend yield. It had pulled back to the 50. It's launching again. Had a MOBO breakout. Everything is green. Pocket pivots and Kahunas rising. On the on-balance volume, that looks pretty interesting. Here's Trident Performance Group. Kind of got away from us. It was up, it looks like almost 10 points, 9 points on Friday. Energy Transfer Partners has been a leader. It also broke out this week. So this is clearly a hot group. Enbridge Energy, as I said, similar patterns. They pulled back, and then after the Fed opinion, they broke out. And they're all being driven by various dividend yields. Here's one that's 5.6%. What else looks attractive? The third group down is beverages. And I can't believe I'm looking at Coca-Cola and Pepsi. We did talk a lot at our meeting about Constellation Brands. It's just right now, its chart wasn't as attractive to me. You could see the group strength, which is this dark gray. You could see that Coca-Cola is in a squeeze. Bollinger Bands are tightening. The yellow is a squeeze, had a mobile breakout from a squeeze, a pocket pivot, and a Kahuna on Friday. That's a breakout, and it pays a 2.9% dividend. These are very defensive stocks. You look at Pepsi, nice uptrend here. So this has been a little bit longer at its uptrend. It pays a 2.8% dividend. Ambev, which I thought also has some alcohol products, or has a number including Coors, not Coors, maybe Coors, but Corona, doesn't look as attractive, struggling to get above the 50. And Stars has been one that I've been in and out of for some time, Constellation Brands, and it's been going sideways. I like to see it show some momentum to go up. But fundamentally, Stars is a winner, or should I say Constellation Brands. Integrated Utilities, again, if this is about dividends, then you'd expect these to look like MLPs. From a chart perspective, and you could see that they had pulled back and they're moving up. Here's a stock that's not extended by any means. Everything turned green, had a mobile breakout from a squeeze 3 trading days ago, had a couple of pocket pivots, and it pays a dividend of 3.6%. That's Exelon. The next one is Duke Energy, kind of choppy in here. It too pays a dividend 4.3%. I think you should be getting the theme here. We're talking about defensive stocks that seem to be the leaders and those that pay interest. Casinos and gaming, I think this is an aberration because if you look at Las Vegas Sands, MPEL, and others, they don't look so good. But Caesars Entertainment's doing some restructuring, was up 13.4% for the 5 days. Empire Resorts was up 59%. I usually are more concerned about things like Wynn and Las Vegas Sands. Let's just take a quick look at a couple of these and see if they look like something we might want to be playing. Here is Caesars Entertainment, clearly in a downtrend. It's even below the 50. I'm not interested. Maybe it's going to come back. Wynn Resorts also in a big sell-off. I don't understand why this list is so high. Here's Empire Resorts. This must be news-driven. You can see it broke up above the 200. Even LVES and MPEL don't look that attractive to me. Continuing down the list, I typically look at the top 10. Aircraft and aircraft parts. Again, this is probably being driven by a number of things. Perhaps it's defensive. Perhaps it's about defense, especially in light of increasing concerns about what's going to happen with ISIS. A lot of other defensive stocks seem to be moving. And here's Rockwell Collins breaking above the 200 out of a squeeze. Everything is green. Kahuna and Pocket Pivots this week, rising OPV. Here's buying a good company near support. I like that idea. It pays a dividend of 1.5%. Boeing, sideways. Can it break above the 200 and become a growth stock again? Well, you had a mobile breakout from a squeeze. The technicals are turning green. You got Pocket Pivots. It pays a dividend of 2.3%. These are not our typical rah-rah growth stocks. Here's Northrop Grumman. Again, like other defensive stocks, Lockheed Martin and others, in a nice bull run, already moving up, and beautiful looking charts. Next one down the list, information services. And I don't really know this group, so I can't make a whole lot of comments. Let's just take a look at the charts. Do you see a chart here that you want to go long on? Well, yeah, it's probably putting in a bottom. It had a doji here, and then it broke out. To me, it's still below the 200-day moving average. I would pass. MSCI, a little bit more attractive, a slight uptrend, and then a breakout on Thursday and Friday out of a squeeze. That's a little bit more interesting. I've played this one, as I know several of you have, which is JRJC. I am out of it now, and perhaps it's put a bottom in on Thursday and Friday and getting ready to run. As I look at this stock, it remains a little bit in a flag, in a pennant, and I'd like to see it break above that pennant before I got back in. If it does, I might expect it to give me sort of this one, another movement like that, or 2/3 of that. Clearly, for me, this was the most compelling of that group. I know this is getting long, so instead of going through all 10, what I want to do quickly now is turn around and look at the stocks, the groups that are not behaving. And you could see a lot of our friends here: semiconductors, biotech, specialty pharma, renewable energy, airlines, auto parts, steel, home builders, banks. How healthy is this market? It can't be healthy when these groups that have been leaders are all ending up on the downside. What didn't make it the 2-day force down, and this is why I like the 5-day force, because if you've started to bounce but you're still down, you might miss that filter, is oil exploration and precious metals come right in there as well. So, clearly we've had fierce market rotation into dividend-paying and more defensive stocks. On the 5-day force, I got 69 stocks down, and on the 5-day force up, I've got only 20 up. So I think we're seeing lots of evidence of at least group rotation, if not the beginning of a tougher time to make money on the long side. All right, I'm getting tired. I know you're getting tired of hearing me. I don't want to spend a lot of time on individual stocks because I think that this is a market we need to know what the market does before we start making big directional plays. Let's just look at a GIF of 10 stocks and then we'll say goodnight. So just to review with people how I make a group inclusion filter, is I go into my designer and I'll just go into the smart groups today. And I'm going to go into my tools here, group inclusion report, and I'm going to identify a number of smart groups. Now, to those of you that don't know the program well, smart groups are pre-planned scans that are done for you and updated every night when you update your software. And I'm going to pick some of my favorites. I'm going to pick best criteria, best of Woodward and Brown, best stocks under 15, those in demand, growth stocks, HGS 100 leaders, quarterly EPS, shadow stocks, stocks and groups to the upside, strong EPS relative strength. I'm going to go into my list. I'm going to pull out, break out from a squeeze, pull back with kahunas. That's sort of my favorite trade, is stocks that have been an uptrend that pull back and have momentum. For Morales and Catcher, I'm going to pull Bible gap ups and pocket pivots. And then I'm going to go into my user groups for this week that I put together, and I'm going to pull the IBD 50, the HGS 100, and the Market Smith 250. Now I'm going to go down here. I'm going to make a group from the report. I'm going to call it Top 10 9.21 web in R. Only want 10. So these are lists of great stocks. And my hypothesis is those stocks that make the highest number of lists are the stocks that I want to buy. So let's run that analysis. And what's really cool about HGSI is it takes just a few seconds to run it. If I want to index no, it's going to open up a web page, which it did on my other computer, and it lists the leaders: Trinity, Gilead, Facebook. I own all three of those. I'm a happy man. VIPs, Activists. So these were the stocks that came up as the ones that hit the highest number of lists. And then it created a user group for me, which, what did I call it? Top 921 webinars. So let's just look at these in alphabetical order very quickly and then say goodnight. I apologize for the length of this, but those who've been here before know I don't know how to stop. Activists is a stock that I've been following for some time. It's the old Watson generic company. It's had a number of acquisitions, certainly a lower left to upper right and relatively tight. It's a leader. It's had great earnings per share. Worry about slowing down. I would look at MarketSmith to see how it looks longer. Everything's green up here. It had a pocket pivot on Friday, rising on balance volume. I think it's a very attractive stock and one I'm looking to find it on sale. So I'm looking for pullbacks to the 50. It's starting to get a little bit up there for my taste. Facebook, I already mentioned, poised for a breakout, one of my holdings and favorite stocks. Gilead has been kind of rough the last couple of days, but if you look at the last week, it's had a nice move up. It broke through its PSAR, but had a tough close on Friday. This is a long-term position for me, so I will protect and collar it. I think I already have a put on it right now. What I typically do on stocks that are long-term holdings, I will buy a protective put that's pretty much at the money. I will sell a speculative put deep out of the money, perhaps closer to below the 50-day moving average. That will pay for a little bit of my protective put, and I'll sell a call perhaps at about 112, 115 area that will pay for part of my protective put. And then I have a position where down to that blue, I'm protected by my married put. And if I break out above 112 or 115, I have the option of selling my stock at a higher value and making money, or buying back my call. So that's how I handle a lot of my longs in this time, and I've already started that move on Gilead. Lanet has been one of my favorites. It was my choice of my A trade in June of stocks that pull back to support and take off. Well, it's pulled back again. It had a pocket pivot on Friday, mostly green. Looks like it wants to run again. Magellan, it's another one of these MLPs that we talked about. Breaking out here, it pays a nice sweet dividend of 3%. Medivation, I talked about this about a month ago. They make a prostate cancer drug that just had an FDA-approved extension of its label. It's in a nice bull run, great earnings per share growth. What I look at here is it's got an $8 billion market cap, and I wonder when its business partner Astellas or somebody else wants to buy them, kind of like pharmaceutics. Salix, another healthcare stock, lower left, upper right. It's a lot like Jazz, but it's got a lot of earnings power coming in the out years. Skyworks, a leading technology stock, at an all-time high, gave up a little bit at the end of the day on Friday, still looks quite strong. It's in the Apple 6. Don't need to see that. And then Trinity is one of those rail plays. They make the cars for the trains. So on that note, here's VIPs, a great Chinese internet retailer. It's pulled back below the 50. I'd probably want to see it break back above the 50 and take out that PSAR dot. So on that note, I think I'm going to call it. Have a great week. Be careful out